Hello and hi everyone. We are from Group 3. We'll presenting about the financial system in German. So, my name is Muhammad Nur Izam bin Ilyas. My metric number is 2753777. Let me introduce to you our group members. Second group members is Muhammad Farhin Fitri bin Muhammad Faisal, metric number 280075. The third member is Ali Martin bin T. Arifin, metric number 280077. The fourth one is Muhammad Izamuddin bin Nasiruddin, metric number 280148. The last group member is Nur Karunisa Damia binti Baharam, number metric 281573. Hello and hi everyone. My name is Muhammad Nur Izam bin Ilyas. My metric number is 2753777. So I will be presenting about the history of the country, which is German. As we know that in the last decade, financial system in Germany was remarkably stable. So let's get flash to the history of the country. In the 19th century, the development of German financial system is characterized by two main features, which is the first one, prime example of a bank-based financial system. Germany needed a lot of capital for the industrialization, which is mobilized by the banks. The second one, financial system includes sectors which involve public saving banks, cooperative banks, and also the commercial banks. After that, by 1913, German banking system has consist of a private sector which is dominated by 8 major banks as a public saving banks and a slightly smaller of the cooperative banks. Then, most European nations have historically had bank-based financial system, while the Anglo-Saxon nations have capital market-based financial system. In the 20th century, German banking laws have historically been changed as following: banks to function as a universal banks. So banks have ability to normalize their operations.
The structure of financial system in German has been summarized in the diagram provided. The German financial system was obviously bank-oriented. Banks were the most significant component of the financial sector, and their total assets were far more than the market capitalization. As a consequence of the dominance of banks in the financial sector, bank loans were the most important source of external funds for companies of all sizes. However, structures and behavioral patterns in the financial sector change rapidly. The rather cooperative relations between banks and banking groups, the pillars of the three-pillar system, were increasingly replaced by stiffer competition and serious conflicts. This was mainly due to the fact that interest margins declined significantly and the profitability of the banks, which had previously been regarded as almost guaranteed, was no longer assured. The big private banks have also repeatedly demanded the privatization of public banks, similarly to what happened in several other European countries at the same time. But this did not happen, and the three-pillar structure of the German banking system was maintained. As the big banks increasingly withdrew from the former core business of lending due to profitability reasons and reduced their branch system, the stakeholder value-oriented saving banks and cooperative banks were able to increase their market share in retail bank and lending to companies alike. Change in corporate finance have also occurred, but to a lesser extent. Only the really large German companies start to finance themselves more through the capital market. The resulting gap in the overall credit supply of the big private banks was largely filled by the savings and cooperative banks, and so these banks increasingly became the house banks for the larger medium-sized company. It would therefore not to be justified to claim that the banks as a group have keys to the main source of external corporate finance. Germany implemented a universal banking system where banks provide both commercial banking and investment banking services, among other complex financial services. This system is strongly reinforced by three main pillars, which are private commercial banks, public saving banks, and cooperative banks that differ in ownership and objective. According to the cross-country comparison, banks in Germany are often less profitable than those in other nations that use similar pillars. The Deutsche Bundesbank takes control of all banks in Germany as the central bank. First, there are private commercial banks. These banks finance the majority of German exports and hold control over 43% of banking assets as of the end of 2020. And being the 11th largest bank globally, Deutsche Bank dominates that industry. They were crucial in the development and expansion of Germany's large organization, assisting them in the effort to grow, gain access to the stock market, establish foreign operations, and complete mergers and acquisitions with other businesses. The major banking conglomerates run retail, corporate, and investment bank as a universal banks. Small and medium-sized commercial banks typically concentrate more on serving corporate and retail customers. For saving banks in Germany, it emerged in the beginning of the 19th century with the aim of making saving accounts accessible for poor people. The saving banks pillar of the German banking system has two-tier structure, including local savings bank and their central institution, state banks. The former are organized according to the regional principle, whereas each bank is only allowed to operate in some particular region. Consequently, local savings banks do not compete with each other, but with the commercial banks and the mutual cooperative bank. State banks, in contrast, are not subject to such a restriction and operate on both interregional and international levels. Hence, state banks compete with big commercial banks. Most German cities have Sparkassen, and Germany has seven Landesbanken, which serve as the primary central public banks in several German states. It functions to support economic development in the respective region and also to subsidize local public goods. They prioritize small and medium-sized business and household, have an extensive branch network, and offer universal banking services to customers of all income levels. The last pillar of Germany's banking system includes many small credit cooperatives. Given that their members who are also owning credit cooperatives typically live in the same region, cooperative banks typically operate on a regional concept. They typically compete with commercial and saving banks but not with other cooperative banks. Saving and cooperative banks often avoid competing with other institutions from the same pillar. Therefore, this partial market segmentation serves to lessen competition within the two pillars. The public institutions are governed by public law, and one of their goals is to promote regional economic growth, and which include providing financial support to neighborhood public amenities like leisure centers and cultural events. Compared to commercial banks, cooperative institutions are also less concerned with maximizing profits because they are often concentrate on assisting their members.
Hi everyone, my name is Muhammad Farhin Fitri bin Muhammad Faisal and my metric number is 280075. I would like to explain about pros and cons of market penetration for Malaysian banks. For pros, market penetration can lead to fast growth for a company. If the bank's objective is to enlarge its consumer base, then market penetration is the most effective way to act. This is because a bank may swiftly expand its client base and reach new customers by penetrating the market. It aids in consumer acquisition and helps the local bank to drive out rivals from the market. In other terms, we might state that lower costs and market penetration are essential for banks' rapid growth. This strategy is very helpful in expanding the market size. As we know, if our local bank is only run in Malaysia, it will focus on a market population of 32 million only. In other way, if our bank in penetrating the market of Germany, the market size can expand to more than 82 billion of Germany's population. This is because a bank can swiftly gain client acceptance and adoption of its product or service by using the penetration strategy. For the next point is more structured and standardized. Market penetration will help banks to be more structured and standardized because the banks are focused on services offered in line with customers. Banks have traditionally provided almost 100 different services to their individual and business customers, just with several consumer per service. Portfolios must be identified and standardized or enlarged as needed. Using a stringent inventory approach, a visible concentration on a consumer needs is essential for this comprehensive approach in order to develop a technology platform that is simultaneously simple and detailed. This enables banks to distinguish themselves from all competition and ensure that the customer is well served. And for the last point is a facilitate digital transaction. Just like we know, banks have become significant financial institutions as the digital revolution has grown to offer an advanced and innovative platform for creating digital payments. Apart from basic services, it includes online transfer, the utilization of money orders, ATMs, bank drafts, and so on. The availability of an electronic wallet is a relatively new feature of commercial banks. Individuals and businessmen used to have to handle a lot of money that was vulnerable to unauthorized accesses. But now they should keep their earnings safe in wallets and use them to access electronic transactions. Good. For cons of market penetration for Malaysian banks is a lack of performance. Performance of foreign banks also can be worse than those of domestically owned banks. This is because, according to one theory, domestic banks are more devoted to their home economy because they have more lasting client ties and a patriotic passion for the common good. In contrast, it is believed that foreign banks focus on lending opportunities elsewhere in the world and may disregard the economy of the host nation if those prospects worsen or if they increase in other nations. Additionally, foreign banks are less likely than locally held banks to heed government's call for maintaining lending during recessions. Foreign banks have occasionally been less accommodating when rationing loans during times of crisis. For the next point is a different regulatory, where a foreign bank face barriers in terms of licensing and other regulatory requirements. As we know, different countries have a different laws and also a different regulation that the company should follow as foreign banks. Each country has its own set of regulation. It's like every regulatory system is a hodgepodge of rules, responsibilities, and financial guidelines. As a result, the danger of disobedience may seem overwhelming. All businesses must abide by the laws and the country in which they operate. This can be a little different than you are used to. When it comes to the international expansion, the first priority should be compliance. For example, the regulation that may cause a burden for a foreign bank are having to pay higher interest tax and also a limited power. Next, Next cons of market penetration was risk of online frauds. Growing digital revolution has not just made operation more effective, but has also inevitably led to online fraud. Cybercrime has become increasingly popular and prevalent in recent years. ATM cards are more vulnerable to theft, and hackers hack electronic payments, username and passwords, and also trick payments illegally. There is a pressing need to enhance the online banking game. Next was a probability of a losing market, where share and amid stiff competition as a foreign banks, our local banks might be losing market share to domestic banks over the year amid a highly competitive environment. Local banks have been growing market share more than international banks, and also over the past 10 years, especially in a consumer banking across the board, including cards, mortgage, and personal loans. It is a very competitive environment, and local banks are increasingly more aggressive. It's difficult to compete because local banks are getting stronger and better capitalized, while foreign banks have been very selective in their lending, focusing primarily on affluent segment where they are able to cross-sell other services like wealth management products. Some local banks are willing to compete aggressively on price to gain a market share and business position in a targeted segment. Given that loans require a lot of capital, these foreign banks are conservative when it comes to lending and heavily returns on equity focus. Hence, growing for the sake of loan market share is not a priority. Because of this, foreign banks will gradually but steadily continue to lose market share, and it can get to the point where some foreign banks, particularly the smaller ones that lack the size to compete as effectively, decides to leave. This is due to the revenue base in a lower but the cost of higher, and the bank has to keep investing in technology to compete.
Assalamualaikum and hi everyone. My name is Nukarini Sadamia binti Barang. My matric number is 281573. Today, I would like to explain about the risk of market penetration among Malaysian banks. The first risk is that Malaysian may face a lack of liquidity support because when capital outflow first began to accelerate, there was widespread concern that Malaysian bank might well face a liquidity crisis. As a consequence, Malaysian bank must maintain cash flow and safeguard their capital reserve from high sensitivity, such as lowering the statutory reserve requirement in order to circulate more leverage into the banking industry. Not only that, the bank should maximize their liquidity in order to give the loan to the customer on time, because when the bank have liquidity which not fulfill the customer need, it will influence customer to make a loan from a good rating bank. The second risk is competition for deposit, which has resulted in some net interest income compression due to the increased lending rate. Deposit in banking system, for instance, were prepared to pay higher rate for deposit, placing pressure to claim more than that for the lending in order to safeguard net interest rate profitability. However, additional automated system and technology investment may not result in the desired cost saving. The problem is, once a bank implements something like online banking, it still needs to maintain its branch, which means multiplying the procedure of handling both office and web transactions. Next, Malaysian banks are quite financially healthy and resilient to changes in the economy. Malaysian banking system is also sufficiently capitalized with the stand any possible increase in non-performing loans. According to the Central Bank of Malaysia, Malaysian bank surplus cash buffer are currently 6 times greater than every financial damage under potential stress. The Central Bank of Malaysia redoubled its effort to raise capital in 2015, owing in part to the impending Basel III capital requirement, which will take in 2019. According to the new regulation, bank must keep a required total equity ratio and counter cyclical capital buffer. The last one, when making market penetration, it will not only focus in one country, but it will involve with other banks from another country. This risk happen when the commercial borrower cannot fulfill to provide the debt servicing due to the government restriction for related to foreign agent. For example, the commercial borrower has enough money to give a debt. However, there are certain barriers to enable them to convert their money to the foreign currency. As a result, the commercial bank have a lot of money in bank but cannot spend their money to the outside of their country. There are some countries that make this regulation because they do not want the bank has a lack of liquidity, which eventually led to the economic crisis for the country. Next is political risk. Political risk occur if a borrower's ability to pay back is compromised, and it involves a broad range of possible events such as state ownership or economic exploitation, as well as harm from civil conflict, political choice, and corruption. Describe the possibility that a country political choice or event would then impact on economic environment in a sense of speculator will lose any money or generate less revenue than they assume. Thus, risk capital predicting the future entails attempting to project the investor harm as a result of a political decision. Risk capital predicting that the future is still relatively undeveloped are when compared like most type of financial modeling and forecasting. Political fallout generally enhance a form of other risks that affect bank more directly. Governance and politician change resulting in policy shift that affect account holder and market wherein they operate. Another risk that Malaysia bank have re-entered those market stocking, concern about another market bubble. An economic bubble is a period in which a current asset value probably outweighs their intrinsic valuation, which is the quantification justified by the underlying long-term fundamental concept. Bubble can form as a result of highly positive forecasts about the scale and conservation of economic expansion, as well as the conviction that intrinsic asset value is no longer applicable.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Izamuddin bin Nasiruddin. My metric number is 280148. So I would like to continue this presentation about the challenges of market penetration. The first one is lack of oversized online payment system. This problem can be a significant barrier to expanding monetization in different countries. As we know, nowadays all transactions are based on the internet. So Malaysian banks should be exposed to the only payment system to encourage more customers to use their services. The next one is high competition among the banks. Each bank wants to position its services number one in the mind of their customer. This may be difficult for small banks like Malaysian Bank to penetrate since they need to compete with high-rated banks. Also, the newcomers are exposed to big banks rather than small banks, which led to difficulties in increasing and developing the growth of the bank. The third one is localization. Localization could be one of the barriers to implementing market penetration, especially for the international market. International market is not just focused on a country, but also has to consider the location of the other countries, especially their regulation and cultures. So, the best way to handle these challenges is to find a local expert who can help you understand the problem you are facing. The next one is changes in regulation. The Malaysian bank may face difficulties when the government make any changes in regulation, which can lead to a favorable or unfavorable situation. If the changes create an unfavorable situation, so the Malaysian bank should be handled quickly. But the other way, if the changes create a favorable situation, Malaysian banks should seize the opportunity by granting them access to any regulatory changes that may be restricted to Malaysian bank. The last one is ASEAN expansion. ASEAN expansion would be one of the potential challenges in integrating finance across the region. It is because Malaysian bank has to generate consumers and business across different jurisdictions. However, Malaysian bank already have a ready-to-go regional business because Malaysia has a large number of foreign workers which put a high value of ringgit on remittances flowing outside of the country.
Finally, for the conclusion, financial system in Germany shows a high level of complementary consistency and stability. Financial system in Germany also has implemented a universal banking system structure. The example is such as they are providing commercial banks and also the investment banks. There are three main pillars in this system structure. The example is the private commercial banks, public saving banks, and the cooperative banks. Germany also has implemented their market penetration. This market penetration can be defined as the proportion of the banks about their product and services. This also will give impact to our Malaysian banking system. Finally, it will create pros and cons with the risks and challenges about this market penetration to our Malaysia banking system structure. I think that's all from us. Thank you very much.